And also let me know if you can see my screen. So our main topic for today is okay. So it's risk management, right? So here I get a message. Sound and clear, okay. That's nice. Um so today we'll be talking about risk management. Um a lot of things that you need to know about risk management is risk acceptance, risk avoidance, and money management. So when we are talking about acceptance, it has to do with you saying basically that you know that there is risk in the trade that you want to take. So now, generally, I'm speaking about because we trade the futures market, right? So we know that there is risk of us liquidating our funds, right? So if you are that type of person, if the trader who says you apply risk acceptance, is more of like saying uh, you trade, but you don't care even though you lose that money. So it's just like you are buying something, you are buying a product for like 100 naira, and you say, okay, even though I lost on this trade, it goes totally on the other direction. I don't care. So you accept the loss. So we shouldn't definitely be this type of trader that just accept risk like that. So instead, we go with risk avoidance. So risk avoidance is basically when you avoid risk, right? So you avoid risk by not trading, for example, a very volatile market when it comes to news. So you know that there is news. And if you are not really good at it, you stay away from the market. Or um, when you see that the market is ranging, you stay away from it. So that's risk avoidance. So you prioritize protecting your capital rather than risking a lot. So when it then comes to money management and risk management, you know that there is risk, right? But then you are the one determining how much of your capital you are willing to risk on a particular trade. So and we have what we call RR, which is a short definition for risk to reward ratio. So RR basically redefines to risk to reward, which is there is risk, but then you want to be rewarded for what you are risking, right? So let's say, for example, you are risking $1, but you are saying for every dollar you are risking, you want to make twice of it. So if I'm risking $1, I want to make $2. So that means if you are risking $1 to make $2, that's one risk to reward ratio, two risk to um 1:2 reward ratio, one RR, 1:2 RR, or you can say 1:3, which is you are risking one to make three times of what you are risking. So, for example, if you are having a capital of like, if you are entering a trade like a $10, right, uh, or particularly any amount of trade, but then your target should be if you are going for 1:3, if you are risking 10, you want to make three times of what you are risking, which is $30. So basically, you're saying, okay, if I'm risking $10, I want to make 30, right? So this now brings us back to money management, right? So money management basically is you being able to like manage your funds, right? Your capital. knowing how much. So this is like also doing like budgeting, okay? So you are budgeting. So this is when trading plan kicks in. So you know that okay, now I've got a strategy. We've been teaching you how to analyze the chart. You know, okay, when you are doing your analyzation and all of it, okay, now you know that okay, there's risk because I'm trading futures. Okay, now you have your capital in your account. Now you go for what a good trader will go for. Now we said you shouldn't go for risk acceptance. You shouldn't go for risk. You should always avoid risk, right? So how you can avoid risk is risk avoidance, like not actually trading the news, or you say, okay, I'm not trading at all. But that's not an option for us because we want to make money, right? So risk avoidance is not something we want to go for. But actually managing the risk is what we want to go for. So minimizing um, our risk. So now this is where position sizing kicks in. You have your capital, for example, it's $100, but you know you then split your capital into like 10, for example. So if you are splitting $100 into 10 places, that would give you $10 times 10, right? It will give you 100 back. So you know that each trade that you are taking, you are using $10 for it. Okay. So which means the $10 that you are using is the amount you are risking. Okay. So you say particularly now that the $10 that you want to use to trade, that's your risk. But then you are targeting 30. But this is just a general rule of thumb. But in general, what you do is risk minimum of 2% of your total capital per trade. So, but then it won't be really realistic if you are using $100. You want to use something more than that. But since we are using leverage, it's very possible for us to go with this, and we are going to break all of it down how you can use that, right? So now, um, if you're having $200, the advice I will give to you, if you're having $100, that's where I recommend that you risk $100, you risk $10 per trade, right? But in general, if you are having bigger capital now, the 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 general risk that is well recommended is like risking 2% max of your capital, okay, per trade. This is position sizing. So position sizing is about you being able to like calculate how much of that asset that you are trading that you should be risking. So how much of the asset you are trading you should be buying. Sorry. So for you to get a proper position sizing, you would first of all determine how much you want to risk per your capital. So now you determine that you want to risk per trade 2%, right? Okay, then you split. You say, okay, uh, for me to have a proper risk management and to be able to protect my account, this is the amount I want to be risking per trade. Okay. Now you have to also do position sizing. You are doing position sizing so that you can buy that exact amount of assets so as to not risk more than that, the exact amount you want to risk. Because if you buy more than the asset that your capital might purchase, there is high possibility for you to get liquidated because why? Your liquidation price now is nearer. You understand? So it's closer to your stop loss, right? Even though in general, we at RoyalQ, our bot doesn't really have a direct stop loss that we can impute, but a very we have a strategy that we use that makes us being able to like apply uh, a proper risk management to our trading, right? So which is margin configuration. So by buying margin, So this reduces your liquidation price and makes your liquidation price far away from you being liquidated in the futures market. Okay. So, but in the spot market, you actually own the asset. So now, if we are going with the basic example of $100, right? Okay, per trade now, I want to use $10, right? So now let's come back to us in RoyalQ. I'll be buying with $10. Okay, that's proper position sizing. You already know that if you're using $10 or $100, that's 10% of your account. But if you were to be using 2%, it would be around $2. So $2 for a position, right, is already not really okay. But I'm going with this $100 choice because to have a proper, because all of us here, we have different capital and we have people who have lower capital. So uh, we can all relate to $100. So I'll go for $100 and I would then recommend I use 10% because you can use 10%. So now for you to have a proper risk management so as to not be really afraid all the time that what if I get liquidated? Or for you not to be buying more, right? So we've always recommended to you also here another way that we've recommended for you to like protect your account. So which is um, a way of us risking better is isolating your coins. It's very essential when it comes to RoyalQ. So once you isolate your coin, that's you protecting your capital, your funds. Okay. So per trade, you've agreed with me that you are going with 10% of your capital if your capital is $100. But if your capital is larger than that, you should go with 2%. So you risk 2%. So you know that, okay, even though anything goes wrong, right? Even though I get liquidated, you already know how much you are risking before you even go into the market. And this is how professional traders trade. Okay. So you already know how much you are risking and you know what you are gaining if the market should go in your direction, right? So you do your analysis. Now you do your position sizing. Your position sizing is you taking that $10. Then now you split that your $10 now into different margin. Okay. So you remember when we were doing our analysis? So let me go come here to for example, this let me pick this buying tool, right? So now, for example, let me say if I buy from here BNB, right? Let me zoom in. And I say, okay, I'll buy from this area and then I'll take my profits around here. Okay. So this is a good risk to reward 1:2. Okay. So I'm risking one to make twice of what I'm risking, right? So now if 2% is what I want to risk to make 4.72%, right? Now I will then go to my RoyalQ platform, right? So I will split my capital now that I'm willing to risk, right? From the $100. You know that if you're having $100 and you are doing your proper risk management, you've already done your position sizing, which is you dividing your account size to the amount of trades that you can take. So you can basically take 10 trades with $100 now. So now you've decided that you are going to take this trade, this particular trade now that I'm making an example with $10. You shouldn't trade more than $10 with this. Anything that, of course, you stick with the plan. $10 with this position. So now, you know that if you put in $10 from here, what you are expecting to make from it, your target now is twice of what you are risking, right? So now you have your first buy in, right, on your RoyalQ platform. Then you set your first buy in to probably around $5, and then you split the rest buy now to this drawdown. So you can then say if this market should drop Since you can set directly your stop loss, now you should be looking for to split the rest funds to around 2.1% in your trading bot. So you buy the margin when this market drops 2.12%. So whatever that then happen after this, if this now should then go beyond this your stop loss size, you should know that you are not to add no other funds. Okay. I don't know if you all understood up to this extent. So if you understood my explanation, please type 2 in the chat box. Let me know. So your target profit is around 4.7%. And your drawdown now, so if the market should drop, your margin that you'll be buying will be around 2 point something percent. Okay? So that is how we are making example with $100 capital. Your position size now would be you to buy with you are trading this very particular trade. Each trade you take with $10 and then you split. Do we all understand? If you understand, please type 2 in the chat box, please. Let me know if you understand, please. So so you see risk to reward between how you are willing to risk the potential loss and how much you expect to gain when you win. Okay. So an example is if you risk $10 to make 30, your RR is 1:3. Okay. If you are risking 10, you should be able to make 30. So on and so forth as per your capital. So okay, source effects. All right. The rest people on the call, does it mean we don't understand the concept? So why it matters in automated trading? Even with a bot, poor RR means consistent losses over time, even if your win rate is high. Okay. So even though you are making consistent profit, if your risk to reward is not on point, you might be winning, but then you will be winning, and maybe most of the time that you are winning, you are making less than when you are losing. Okay, if you don't have a proper risk management. So let's say, for example, you win most of the time, but then you don't have a proper RR, risk to reward. You are making maybe every time you enter with a trade with a $10 that you are risking, potentially, you're making like maybe $5, for example, right? But then your target now is not up to 1:3 or 1:2. But then when you are losing way more, right? So you are losing maybe $20 when you are losing. You are not making up to when you are winning, okay? But then if you have a consistent risk to reward ratio, you are able to maintain, because why? Even though you lose, you have a losing streak, you will still be on the winning side, because why? Your risk to reward ratio is actually accurate. You might even lose like $10, 3 trades in a row, but if you have 2 trades that win, you gain more. Okay. So ideal strategy, minimum RR is 1:2, and risk $1 to gain $2. Okay. A 50% win rate with a 1:2 R puts you ahead long term. So like I was telling you, So if you were having let's say $1,000 your capital, you want to risk 1%. Okay, you want to risk 1%, maximum 2%, and then your leverage that you are using, you shouldn't use too much of the leverage. The RoyalQ, the maximum leverage that we can use on RoyalQ is 20%. And for you to have a proper risk management, I always recommend that you use nothing more than 5x leverage, so as to minimize your risk, so you don't blow your account. Because on the long run, if you are having a proper risk management, you'll always be on the winning side. Okay, so is there any question up to now? Do you have any question, please? Do we all understand? Please, if you understand, please drop two in the chat box. We have sound effects. Okay. How the capital that converts margin. So my area budget to margin 3. So my conversion big bar margin 3, but get liquidated. I usually have a check next. I don't know why the margin 3. I don't know why it didn't buy margin 3. What actually? Leader Peter, please, I don't really understand your
Uh,
question. You can unmute.
can I come in? Can I say what happened?
Yeah.
Liquidation price might be because of he's using 10x. It
Mm.
might be that the liquidation price is if the price is $2.5 and is a short trade, his third margin was to buy at 2.3. You understand? So it hits the liquidation price first before the margin call price. So that
Yeah,
is
yeah.
that's why if you are setting your margins, always consider your liquidation price so that you cannot just set your margin 10% drop, 7% drop. You have to check it to make sure that they fall within the range. They don't exceed or near your liquidation price. So that is what happened. That
Of
is why
course.
you got liquidated before the third margin.
Yeah, of course, of course. That's so true. So before you even, that's why I was talking about position sizing actually. So let me get deep dive into this concept of position sizing, why it really matters. Okay. So from the answer that I just gave you, right, you always have to consider your liquidation price whenever you're setting your so even though you buy 10x, right, at times you could buy 10x, you could use 10x leverage, and you will get easily liquidated, and your liquidation price will be far away from you. You know what? Why you would have your liquidation far away is when you put position sizing as priority. Because why? If you don't do position sizing calculation, right, you buy way more of that asset that your liquidation price will be so close that you get liquidated even before you could buy the margin. So now let me give you an example of what I'm saying. Okay. So now imagine you want to buy BNB right now, right? And you want to buy mm, you want to buy with $10, for example, right? You want to buy with $10, and then you use 10x leverage. But if you buy more, right? If you buy more without considering your position sizing, you actually and you use your your leverage. Instead of using maybe 5x leverage so that you can buy lower quantity of the amount you can buy that will make your liquidation price far away, and you buy more of that asset, your liquidation price now will be close to you. But if you buy the exact amount that your capital can afford, the liquidation price will be far away. I don't know if you get my point. So now, for example, let's say, for example, now, your $10, it's supposed to buy you, for example, $500, 500 quantity, right? Let me just give you an example of that. 500 quantity, but then you use leverage, right? 10x. Then you bought more of that asset. Instead of buying 500, you now buy 1,000. But then actually, if you do your position sizing right, you are not supposed to. It will keep your quantity that you are buying now consistent with your equity, so as to keep your liquidation price far from you. Like, it will reduce the liquidation price. But if you buy more than what you are supposed to buy because you use higher leverage, your liquidation price will be so close that even the drop down that you want to draw, maybe 3% that you were targeting to be your stop loss, now will be far. So what happens basically is that, okay, now you are targeting to when you are using leverage, actually, when you are using leverage, if you buy this asset, right, your equity is the distance to your stop loss. So what happens is they are lending you money to add to your capital to buy that asset, right? But then your equity now is your distance from where you bought your entry price to your stop loss price. But if you bought more assets, what happens is that it shifts your liquidation price now closer to your entry, instead of it making it to go even way lower than what your asset is. Because why? Your liquidation price now is measured from your entry price to your stop loss price. I don't know if my explanation is clear.
Please, can you repeat and explain again? I didn't get it clearly. Thank you.
So the thing is, you see, when you are using leverage, right, in the futures market, you are using, if you're using 5x, right, and you are using, for example, $10, right? Let's say you are multiplying $10 now times 5, right? So now you are assuming that your equity now is your own personal capital that you are using to trade, plus the money they are borrowing you, which is the borrowers fund, right? So now, whenever you are trading, right, how liquidation price is being calculated is that whenever your equity now is lower than is getting closer to so let's say this is your entry price from here, and this is your stop loss price, and this is your TP. Okay, your equity now will be measured from your entry price to your stop loss price. So whenever it hits, the market goes in the opposing direction, your equity now is what is reading, right? It's minusing away from your equity. But then it gets exhausted when it gets to your stop loss. But let's say now, for example, you bought more assets way than what your equity can cover, right? You draw down your equity can cover. Your liquidation price now, instead of it to be lower than your stop loss price, it comes closer now, and you get liquidated easily. So do you understand?
So you mean that the higher the leverage, what you're saying, the higher the leverage you use, the more closer your
Your liquidation price
liquidation
gets,
price gets to your entry price.
of course. Because why? The exchange doesn't risk their own capital. The exchange doesn't risk their own capital. Whenever the trade is going against you, it's your capital, your actual capital that will now be reading. Okay. But then
It's
if
the actual capital
mm,
that they will use to calculate your liquidation price.
your liquidation price from your entry
That's
price,
what they borrowed you.
yeah, they don't risk their own money. So whenever your capital now gets when it gets read out, you're out. Okay. So now you know that, okay, yes. But if you bought, if you did your what's it called, your position sizing, where you buy lower quantity, you won't buy much quantity now, right? Your liquidation price now will be lower. Okay. And for you to get a better amount for your liquidation price, right? This is how we do the calculation. Let me show you how to do the calculation. Please confirm to me that you can see my calculator. Confirm to me that you can see my calculator. So let's do a practical something. So now, for example, I'm having $100, right? We all agree that we want to use $100 because that's like the general amount that we can use. But if you were having like maybe, for example, $1,000, I already give you the formula. Just use for you to have a proper position size to be able to risk that exact amount that you want to risk, right? On any trade, right? Let's say you did your analysis already, okay? Your target now is 1:3 risk to reward ratio. You already have the amount of in percentage that you want to risk for this trade, okay? And you have your target here. Now, what you want to do now to have the proper risk management is to take this amount in percentage, right? That you want to risk, okay? You calculate it with the amount, your amount that you want to risk from your capital. Which, if you are using $100 now, you say you split your money into 10, which means you are using 10%, right, of your account. But if you were to be using more than that, what you want to use now is like $10 from $100. But if you are using a bigger amount, risk only 2% of your account. Okay. So now we agree that the amount I want to risk is $10. Okay. Now I will divide this $10 now with this percentage here, 2.12%. 2.12, and then I'll add percent. Then I'll equal. So this now will give me 47.1. So now this 47 now is what is the quantity of the is the quantity I'm gonna have to buy in my exchange. I don't know if you get me. So now, if you were to be, if you don't go to your exchange now, so any amount that this amount gives you is what you are going to go plot in your, what's it called? Your position amount. So your position amount now, this is what you are going to go. So basically what you are going to do is, okay, the risk amount divided by distance to stop loss will give you the exact position amount that you want to buy, so as to not risk more than what you can actually you are willing to lose. So now if you are willing to lose, for example, $10, you don't want to risk more than that. So for you to be able to do that, you want to calculate, you want to do your position sizing right. And for you to get that, you have to divide your risk amount, which would be your total risk from your capital. So you already have a specific amount that you're risking from your capital, which is, if the general amount is 2% of your total capital, and if you were to follow the $100 capital, it will be $10. So now you want to divide $10 by your distance to stop loss, which is 2.21% here, for example, right? So distance to stop loss divided, then you put the percentage equals the exact amount that gives you will be your position size. So you won't be able to, you will be able to buy the exact quantity that $10 can risk. But if you buy way more than that, so say for example, you just pre-assume and you just buy any amount, you buy more than that, and what that does is it's make your liquidation price now closer to your stop to your entry price, which means quicker liquidation. So I hope I'm able to explain that better.
Wait, I'm coming. Let me answer. You said if you buy more than, if you calculate it now, is 47. Is it 47 quantity you are going to buy? Won't you calculate it? That 47? Will you not times it by your leverage?
Yeah, of course.
Okay.
So basically, if you already know the leverage you are working with, right? So you know that okay, yeah, you are having a 5x leverage or you are using a 10x leverage. You say, okay, this is the amount of leverage I'm using. So I have someone here who said he wasn't conscious, Chijoku, that said he wasn't understanding the analysis. Please, do you understand now? Or you still don't understand? So how to apply RR in both settings. So clear TP levels, define profit and stop loss distance based on a favorable RR. Avoid tiny profit plus big losses. So that was exactly what I was saying earlier. So if you have a consistent RR, higher possibility when you are, even when you are making loss, because we are not perfect when it comes to analysis or prediction of where market is going to do. You do your analysis, but then you know that you have a consistent RR. If you have like maybe 1:2 RR or 1:3, follow that. Even when the market is not going as planned, right? So let's say, for example, now you've you divided $100 into 10 pieces. Imagine you took 3 losses in a row, right? And you lost 1. That means you've lost 3 times, right? But then anytime you are winning, it covers your, if you then, so now let's say you lost three times. So now, for example, if you lost 3 times, you lost $30, okay? But then now imagine you won twice. How much do you think you will make? Do you have anybody who understand, who can tell me how much you are going to make if you make 2 times of 1:3 from our trade? Let me see if you understand. If you know, please type in the chat box so you can unmute and tell me. So if you were following a consistent 1:3 risk to reward ratio, and you lost 3 times in a row, right? And you were risking $10 per trade. How much will you make if you made twice? If you got 2 wins, 2 winning trade, for example. Let me see if you understand what I explained. This topic is very complicated,
you will make
but
profit of
I promise you to understand it. Profit of $10, is that incorrect? Because
after you must have removed your loss of 3 trades, which is 30. Normally, if you make the profit for 2 trades, you get $30
which is
as
60.
profit.
Then if you
That
then
is
lost
easy.
what's it called, $30, you will make
If you
30.
remove capital, from the 60. That is 40 is your profit. So if you remove your loss from the other 3 trades, you will now be left.
I said if you make two wins and you lost 3 times in a row.
If you make 2 wins, now you use $10 to make $30 profit.
Yeah, but 2 wins now will be 60.
50. Okay, that means you are saying apart from your capital, you make this profit. That is 40. Okay.
So
Okay.
it will be 30 because if you are risking 10, the amount you are risking is $10. But then when you make the wins, you make 2 wins is $60 now. But then you've made 3 consecutive loss, which is $10 times 3. That's $30. $30 minus 60, that will give you 30. So which means if you maintain a proper risk management, you will always be on the winning side, even you have like bad trades in a row. But if you maintain that and you have a proper strategy that you're using to enter the trade, you maintain consistency and proper win. Just always try to refine your strategy. Always try to also do back testing and forward testing. So actually from our slide, we have that here as recommended. Okay. So for you to have so I had a topic that I was supposed to even speak about, which is drawdown and stuff like that. But the time won't permit us actually. But what I will always recommend is that you have a consistent RR, your risk to reward. You follow your plan, which is you should have a plan as a trader, right? Okay, this is what I'll be how I'm going to be trading, this is how I'm going to be executing, and this is my risk management. I have to follow it. And whenever
excuse me, Olida Abiola.
yeah,
How are we going to use $10 to make 30 profits? Is it that we increase? I don't understand. With 5, are you saying we are going to increase the take profits or we are going to increase? Which one are you going to increase to give you that $30? As in 1:3R and 1:3.
so for you to make 1:3 risk reward ratio, right? So if you were to be using 5x leverage, right? If you were to be using 5x leverage with $10, how much would that give you?
With $10 is $50.
Okay. So $50 now. If you were making 4% of $50,
$2.
how much?
That should be $2.
It's $2.
Okay.
Before someone will now make $30 from $10.
Okay,
Hey, see, I was talking safe. I did not unmute myself. I was saying that for person to get that $30 profit using 5S, it means that the person will increase the take profit percentage. Now, it will be based depending on the movement on of the coin, because some coins, if they go in your
realistically, the profit won't be up to that because of the leverage, really. Because me, I'm calculating based off most of the leverages I use. But
50 leverage or 100 leverage.
but normally,
But come to think of it, it might be at least that one is only $10 you just set 100 leverage. If you liquidate, you will just chase the $10. But if you go in your favor, 10 times 100 is is $1,000, right?
But we could do like a realistic what's it called calculation of risk, and in our next class probably we'll treat this class again, and then we'll do a proper breakdown of how much each leverage would be per trade when we are using 5x, or when we are using what's it called 10x, which would be maybe maximum. But what I will always recommend for our team is 5x leverage, and then we should always be targeting like maybe 1:. So the strategy doesn't change, right? So if you 1:3 is 1:3, 1:2 is 1:2, right? But then what changes is how much you are risking per the trade, like the capital that you are using the trade. So regardless of the pair you are trading, it doesn't change. What changes is the leverage, because if you are using more leverage and you are not calculating your position size, like the quantity of that asset that you are buying, you will be risking more because the calculation will not tally. You understand? And the more you are buying with lower capital, like for example now, if your equity in that asset that you are buying is low and you are using higher leverage, you will be able to acquire more of that asset. But what that is doing is that you're having lower edge when it comes to your distance to stop loss, like your distance to liquidation. So which means you are having disadvantage practically, because it will tighten your stop loss. Like if you tighten your liquidation price to your entry, it will be like head to shoulder, like it won't be far at all. But if you buy lower quantity, regardless of the leverage you are using, it will distance it. You understand? But the profit margin will actually be almost as if you are using what's it called? Even if you are using what's it called? Let me promise you one thing. If you do your position sizing very well, right? The amount you will be putting on upfront will be very small to the quantity you are going to buy, and you will be risking the same amount. So, but then you already know that okay, this is the amount, this amount that I'm putting upfront, I'm willing to lose it already before even going into the trade. So I don't know if you get me correctly. So by next class, we'll come with a proper what's it called calculation for the leverage that we recommend. So I hope we all understood today's topic, please. If you understood what we taught, please type 1. If you don't, let me know. You can just do that by raising up your hands or dropping your question in the chat box, please. So do we have any question, please?
Leader Avila, thank you
Yeah.
so much. Good evening. I wanted to, ask a question.
Yeah.
Does it mean that margin calls don't help?
Actually, they do. Why not? Margin calls, once you buy them, they reduce your what it does is, if your margin, your liquidation is like for example, you bought something at 1 naira, right? And it goes, the market price now goes against you. It wants to like 80 kobo, right? It means you are losing like 20 kobo, right? So now, if you buy now, your margin call now comes in, like you buy now at this new market price now, which is 80 kobo. It means now your liquidation price now goes below 80. Okay. So which means you have a new entry now. So your liquidation price now will drop. And it makes your liquidation price now, it gives you a breathing space, so as market can now be able to, like, since we know that market is not very stable, it moves in waves, right? it might be a pullback. So now imagine that you have a perfect analysis. The market is supposed to go your way, but because you have a tighter, what's it called, stop loss, liquidation is very close to you, then you get take out of the market. But if you have a bigger space, it might actually go your way because you don't get liquidated before market is going to feel your take profit. So you buy once you buy the margin call now, it makes your liquidation price now far away from you. Okay, which means you added to the capital that you are buying. But then that doesn't really mean that you shouldn't do a proper risk management by actually splitting your funds properly. So by doing a proper position sizing and then money management. Okay, money management in the sense of how much will be your first buy in and how much you are going to consider for your margin. Okay, which now your margin configuration in RoyalQ is very essential because why? If you are doing margin cost, if you are buying margin cost, that's your stop loss that you are using. So now, okay, you know that, okay, if you buy margin, your liquidation price now goes down. It gives your trades now breathing space to be able to now fill your take profit. So now imagine that your stop loss was at around 2.2% here. But then price came close to almost taking you out. But then what happens? You place your margin call at around 1.5%. Now instead of your stop loss to be around 2.1, it might go all the way to 2.5. So which means market can come here and then pull back to go back to go take your profit. So margin call is very essential. And that's why we told you to do a proper position sizing. So you can also do a proper money management by actually knowing that, okay, you don't buy the asset, you don't go in all with your capital, you split. So I hope I was able to answer your question with the answer.
All right, thank you so much. Yeah, I do know that margin call helps. I think where I got confused, I thought when you were explaining equity, I confused it because I know that margin call has saved me a lot also.
Yeah.
Has helped my trade also. Yeah, it's clear now. It's
okay.
actually clear now.
Mm-hmm.
Yeah, I felt like that was what you were kind of mistaking it for. So, regardless, if we are trying to say, okay, for example, we want to dedicate $10 to one trade, that means we still have to split the $10 and also use margin calls with it.
Yeah, of course.
That's it.
Yeah, of course.
Yeah.
And the reason why I'm saying $10 is because I'm being considerate of we have people who have
Yeah, I know. I understand.
and
Yes.
if you have more than that, $10 now is not the case anymore. You should follow the general rule of thumb, which is like the percentage. So the percentage you should be the maximum you should be risking per your capital should be 2%. Even when your capital gets even bigger, you should even consider to use less than 2%. Because imagine that from 2% of $1,000 is $20. Okay. But then 2% of $10,000 is not 20. It's way more than that. So 2% of $10,000 now is $100. So you compare that. So you know that, okay, you will be the one now to decide, am I able to risk $100 per trade? So I'm talking from a perspective of someone who trades outside of RoyalQ. Okay, but then we have a system which actually permits us to have a proper batting average system by using the strategy we are using on the platform. So you are able to mitigate your risks very well. So it's actually a blessing.
Yeah, thank you so much. That does make sense.
So
We also have to look to this part.
okay. So without taking much of our time, I think we even surpassed the time already. We should all please show up for the classes, but most especially apply the knowledge that we are getting. Apply the knowledge, because if you don't apply, it doesn't really help. It's like a total waste. Okay, so anything you learn, try to apply, try to make your own personal research, and you will definitely improve. So and if you don't make mistakes, you can learn. You can easily learn when you make mistakes. So I hope we have a winning week ahead. I saw the crash in the market yesterday. You all are not alone. We are all here, you know. So it's something that does happen all the time in the market. So it's part of the game. So good night, everybody.
Thank you. Bye.
See you all tomorrow. Bye.